Hello, world. Today is Sunday, August 30. Today is episode number 56 of the 39.6 Facebook Live Finance Show, the show that teaches high earners like yourself how to make your money work for you so you don't have to work for your money. We talk general investing, taxes, real estate, syndications, Airbnb, and even the car you drive. Today is a very special episode. We have Veena and Ellie Perlman here in the studio live with us today to talk about Element 41, our current 506c syndication deal. They are our two wonderful co-sponsors. Let's welcome them to the show. We are having Veena and Ellie. Perfect.
Hi. Hello.
By accident. If you're out there and you can hear and see, please let me know. Please let me know where you are chiming in from so we can interact with you guys in our Facebook community. Please feel free to hit a share or make a watch party. That would be pretty awesome. Sorry for the slightly late start. We've had some technical issues, but we are all here and we can all see and hear. I'm going to try to get myself into the view of the camera now because I narrowed my screen. Okay. Anybody else out there? Please say hello. Okay. We have Veena and we have Ellie. Veena, we had you on for episode number 50. For those people who are not with us before, can you please do a quick introduction?
Yes. Hi, guys. I'm Veena Jetty. I am a founding partner at Vive, which is one of the sponsors on this deal with my co-sponsor, Ellie. I am a multifamily sponsor who targets Class B assets in very specific niche markets. This one is in one that we really love, which is Atlanta. And I know we're going to go more into the details of the deal, so I will leave it very short and sweet.
All right. Thank you very much, Veena. And we have the wonderful Ellie Perlman. Sorry, I didn't have music. You had the music right before. Sorry.
Hey, Victor. Hey, everyone. Just a few sentences about me. I'm the founder of Blue Lake Capital. I have my own podcast actually ready to scale. I used to be a real estate lawyer and a property manager. That was many years ago. Just like Veena, my partner, we're basically targeting Class B assets in Texas, Florida, and Georgia. And we like to buy in strong areas. We like to buy properties that need a little bit love and attention and make them from profitable, turn them from profitable properties to even more profitable properties. Working with investors. I love what I do. I love real estate, and I'm trying to have fun as much as possible. And yeah, that's it.
All right. So Ellie, how big is your portfolio now in terms of total properties, doors, valuation, if you don't mind sharing? Sure.
So with our strategic partners, because we're affiliated with a family office, we own over 2,000 units. We do have about 776 or 7 in asset under management, and that's going to grow by almost $1 million. Sorry?
$767 million, like you said?
I'm sorry, can you repeat that?
Did you say $760 million in assets?
276 doors.
Doors.
So we own about 250 million, and out of that, about 100 in asset under management.
Okay, wonderful. And how many years ago did you start working directly on your own in the multifamily space?
About 3 to 4 years ago.
Okay, so you've amassed quite a portfolio.
Yeah.
Okay, and can you tell us a little bit about your podcast?
Sure. So Ready to Scale is basically, it's a fun podcast. And it talks about, real estate, just like we're covering Airbnb and syndication and single family, multifamily, but the focus is how you can scale your portfolio, how you can scale your business, whether you are a passive investor who wants to scale their portfolio or a syndicator that wants to grow and, scale their business. That's the main focus of the podcast.
Wonderful. Yeah. So I think a lot of us started off in a single family space and something that we felt like we could munch on. But then you quickly realize that time is not scalable. Are your efforts in single family? You can only go so big, so fast, so far, and ultimately, I think that's how a lot of us got into the multifamily space. So I still have my single family portfolio, but we haven't been adding to that, and we've been adding quickly to our multifamily. So that's where we are today. And so for the listeners to this show, so I have a fund that I am bringing into the table to invest into this asset, and this is a 506c syndication. So this is a public asset. This is something that we are providing and can be done online in the public space, as opposed to other deals which are 506b and only limited to people that we know directly. I hear something in the background. I wonder. That's my
kids.
3-year-old. I think she just woke up from her nap, so she will find mom in just a moment. I think mom is hopefully listening on the show and realizes that she's awake now. Okay. So we have this fund, and I am bringing money to the table into this large asset, which is the biggest asset that I have had the privilege of investing in. This is a basically almost institutional size asset, Element 41. And for people who have not invested before, I have sent an email out. Please send questions directed to me after this, but we have Veena and Ellie here to answer more questions live for you today. And feel free to ask questions on the panel right here. You can text them in, and we will address them. Okay, but especially for newer investors, I am going to bring up. Let's see which layout is going to work best. Okay, we'll try this for right now, and I'll try to make the PowerPoint a little bit bigger. And so for people who are interested in the deal, please understand that this deal is, even though we are raising a lot of money, we are actually pretty well subscribed at this moment, in millions of dollars of investor soft commitments. So we usually will still have some room. There's usually some people who come off the wait list. So if you are interested, please submit your information as soon as possible, so that we can at least capture you. And as spots become available, or if there's still a little bit of space, we're very close to the edge right now. We can get you in, but please fill out the information quickly, even if you're not 100% committed. Okay, so I have brought up some of the slides, and the investor deck has been sent out to everybody who has been on the mail list. So if you have not gotten this, please join the sign up list for syndications in the Facebook group. The property here is Element 41. Okay, and the deck is over 50 slides. We're not going to go through all of this. Okay, but I do want to focus on some key things, and then also the questions that people have. Okay, so we will jump into the investment summary. And for new investors, actually for all investors, there is a minimum of $50,000, and it's for accredited investors only. So that means you have a net worth of $1 million outside your home, or you earn $300,000 a year and you've earned it for the past 2 years coupled with your spouse, or $200,000 by yourself for the past couple of years. And you can continue to plan to make that money in the current year. You can also be in an entity, and there's different rules regarding that. Okay. Minimum investment is $50,000 on the Class B side. And we're going to get into that information in a little bit with respect to the capital stack, which again, we discussed previously on episode number 40, and how the capital stack works. Okay, so Ellie, do you want to talk to us a little bit, just broad strokes, about the property?
Hey, Victor, yeah, before you guys start, can you just move the title down because we can't see Ellie?
Oh, so wait, what are you seeing? The title of
the episode 56, Element 41.
Yeah,
So she's just eyes looking over the wall.
At the bottom of the screen. And let me get this.
There we go. Now
There we go.
can see
Okay.
it.
All right.
All
Okay.
All right. Thank you, Veena. So, just not to bore everyone with the details, but the important things that you are probably interested in as potential investors is that we're talking about 494 units in Marietta, which is about 20 minutes outside of Atlanta. Very, very good and solid submarket that attracts a lot of families and young professionals. This is a 1988 property, and it's really, when you walk into the property and you walk outside, in the common areas, it feels like a little, almost kind of a little, its own kind of neighborhood. So the property is beautiful. It's well maintained. Some of the units are classic, meaning they haven't been touched since the property was basically established. And then some of them have kind of light renovation and some very nice renovations, and they're getting nice premiums. And then the outside is very beautiful, very green, a lot of trees, pretty much, in terms of amenity package, no other property is like this one. And that's extremely important, especially during COVID, where people can't really go out and do much, and they have to, kind of stay close to home. So this is what you see here. If you can see, you see kind of an outdoor gym. You have several areas. You have a sports court. You have jogging trails, 2 pools, and you have 2 dog parks and 3 different areas for barbecue, and even more that I can't really remember at this point, because there's so much to do in the property, and that's a major attraction. Because every time you buy something, you kind of want to think, one of the things that you should consider is, how is this property special? What's the strength of this property that will make it more attractive compared to any other property in the area? And the amazing amenity package is definitely one of them.
All right. And this is located in suburban Atlanta. Is that appropriate way to say?
Yeah. And maybe, Veena, if you want to talk a bit about the location.
Yeah, it's suburban Atlanta. So it's definitely that like nicer area. The school districts here are one of the most desirable in the entire MSA, which is something we really like about it. But we also really like that there's a lot of really big headquarters that are within driving distance. So you have Lockheed Martin right down the street. We're next door to an Air Force base. Home Depot is right there. And so this is a highly sought after part of Marietta. And Marietta is actually divided kind of into like 2 different areas. So their school districts are like East Cobb and Cobb. And so Cobb is the more desirable one. And so that is where you see kind of like the increase on home values there. And so we are in that school district, which is great.
Okay. All right. Wonderful. And Ellie, you have a number of assets in this MSA already. Is that correct?
Yes. Yeah, we have other properties in Atlanta, and this is that's one of the main reasons why we're focusing on Atlanta right now, is because our portfolio there is actually overperforming compared to also the other assets that we have in Texas and Florida. Those in Atlanta are actually performing very, very well. So since COVID, we were able to get 28.6% increase in rents. 30% increase in NOI. The weighted average of the portfolio in July was a 30% increase over the average pre-COVID. So just to show you how solid, how strong this submarket is, our occupancy also increased in those properties. And right when COVID started, I actually read an article that basically predicted which markets are going to be least impacted, and Atlanta was one of them. And the reason behind this was that Atlanta has, the concentration of small businesses is not very high. You have a lot of large corporations like Lockheed Martin and other corporations that are there, so they're more resilient, and that's what makes Atlanta so desirable. It's also very affordable, so you have more people moving there actually and escaping, the big cities, the more expensive areas. So this is just good to know. And one more piece of information about Atlanta is that basically there are, based on the CoStar report, there are 3 markets that their rents have surpassed pre-COVID rents. One of them is Atlanta. And if you're curious, and I'm sure you are, which are the 2 other markets, it's Portland and Philadelphia. And so Atlanta is right there. And these are the only 3 US markets with higher rents than pre-COVID, just to show you how strong the demand is and how solid the market is. So of course, depends on the submarket, depends on the property. We're not saying we, guarantee, 26.5% rent increases. And in fact, we underwritten so conservatively not to include any rent increases, even though we do intend to push rents. But just, the fact that the market is doing well, we have documented research about it. We see our portfolio overperforming. This is why we basically said we're going to focus on Atlanta right now and try and find the next deal there, because we can see how well our properties and other properties are actually doing there.
Wonderful. Okay, so as an investor, at least for me particularly, and a lot of the people whom I work with and people who invest with me, our biggest concerns are we're relatively conservative and we're not shooting for home runs. We really just want to make sure that we're getting safe, steady returns, and we'll preserve our principal. Veena, can you talk to a little bit about how this deal was underwritten and how we are making sure that we are going to help maximize the likelihood that investors preserve principal in this type of an investment in an uncertain time as we are in right now?
Yeah. And I think Ellie kind of touched on it a little bit. So we've actually changed our underwriting metrics quite significantly since pre-COVID to now. So general rules of thumb that we might follow, we aren't following today because we are just still in that kind of period of instability and turbulence in the market in general. So like Ellie had mentioned, one thing we've underwritten for is 0 rent growth in the first year. So while we intend to push premiums and we intend to increase the rent, we have underwritten as if there's going to be no rent growth. And in fact, internally, we've stress tested where we actually lose money from the current T12. So the T12 is what the seller is already getting and has been getting historically over the last 12 months. And we've actually taken that and gone down as we've internally stressed it, even though it's a highly unlikely scenario. Even a 0% rent growth is an unlikely scenario for us. And so what we are also underwriting for is a 0% increase on the other income. There's already other income that is coming into the property that we haven't even taken into account, and additional other income areas, which we've had success with in other assets that we own and manage, that we haven't accounted for here. So the chances of us being at like a 0 overall growth on the income portion of the T12 is not really a likely scenario, but if it is, great. I mean, the numbers that you see in this slide deck are based on that 0.
Okay, so how much in a typical deal with pre-COVID underwriting would you underwrite for and put on the pro forma for first year growth?
Yeah, so I think it depends on the market you're in. And maybe I should let Ellie speak to the Atlanta market because she knows it a little bit more. But for us, typically anywhere from 3 to 5% on the rent growth and about the same for rental income. Maybe 4% is a pretty standard number that we see in our markets. Is that what you do in Atlanta typically?
Yeah.
Okay.
Yeah, that's pretty standard. Again, this is pre-COVID. And so just like what Veena said, we're actually, just for underwriting purposes, we are assuming no growth in year 1, which is a very extreme scenario for us not to be able to push, not even to get $1 higher than what the current, owners get. I think that's pretty extreme, but we like to be extreme because, I used to be a lawyer. I'm conservative in nature. I cannot help it, even if I want to. And Veena is investing her money in the deal. I'm investing my money in the deal. My father-in-law is investing in the deal. It's a very conservative, investment. And even our lender called us. And lenders are very, very careful, these days. And when they saw the deal, they called us. Actually, I got a phone call from 2 different lenders that said, "You're being a little bit too conservative. You need to change your numbers." And I always said, "Listen, this is how we see the deal. I mean, there's no other way for us. That's how, we want to protect our money, want to protect our investors' money." And just a quick sentence, something we haven't mentioned at the beginning: this is not an offer to sell securities. We're not registered, investment advisors, and the full offer would be in the form of the PPM, the private placement memorandum, if that Victor is going to send you once you're interested in the deal.
Thank you for that information and clarification. Okay, so regarding the debt, and you were starting to get to that, Ellie, what kind of debt terms are we looking at on a type of opportunity like this? Because I see a lot of offers, and I know that a lot of people who sponsor deals, they try to push the cash on cash return. I see a lot of offerings where the loans are like 3 years with a balloon payment, because they're trying to get every little bit out of cash flow, so that the investors can say, "Oh, I'm getting 9% or 10% cash flow." What kind of deal with respect to the debt service are we looking at on this type of a project?
Yeah, that's a very good question. And that's another way of basically, explaining how we look at deals and how conservative we are. We could have taken a 2-3 year loan, a bridge loan with, allow ourselves to get more cash flow. But what's going to happen in 2 or 3 years? Are interest rates going to be as low as they are right now? I mean, probably not. So to be conservative, we basically took a fixed rate Freddie Mac loan for 10 years with 4 years of interest only payments, could be 5, and interest rate is pretty good. It's 2.86%. Could be a little bit lower, a little bit, higher once we actually close the deal. But I like to know how much, we're paying every month. I don't like surprises. I want to be able to know until, when we exit in 5 years, how much every month we need to pay. I don't want to, try and refinance in 3 years if I don't have to. Maybe I'll say, Victor, we took this 10-year loan. It's year 2, and I have a great opportunity to refinance and pull up equity and give investors, at least some of the initial investment back. And it makes sense, and maybe we'll do it. But we didn't underwrite a refinancing into, this is going to be just an addition to all, everything that we're projecting. So very conservative, low interest rate, fixed rate. I want to know, there in every deal, there's risk in every deal. Nothing is certain. And there's so many, I would say there's so many variables. And so if I can get rid of some of the variables and make them fixed, then, my formula is a little bit safer, and that's what we're doing.
Okay. And yeah, 10 years is a nice holding period, and that's a 30-year amortization, right? That will kick in principal and interest after the 4th or 5th year has been completed, depending on the final terms of the note. But 4 to 5 years of interest only, that's a favorable term. Yes, base. I mean, I've seen some deals that are only 1 or 2 years of interest only. I haven't seen anything more than 5 years. I don't know if there are programs like that out there, but at 2.6% on a 30, that's cheaper than I can get on my own property. Right?
Yeah, that's the whole point of it.
Sorry, Veena, were you trying to add something there?
Oh, yeah, I was just going to say there are 10-year interest-only terms that you can see, but they're typically not going to be on agency loans. And to be honest, Fannie and Freddie, when they are underwriting loans, when you see 4 and 5 year IO periods, it's usually, especially on a loan this size, it's because the sponsors have a strong enough resume to be able to justify that. They see us as borrowers as kind of lower risk borrowers. So that's why they extend it to us. But oftentimes when you see these bridge loans, it's taken for 2 reasons, right? Number one, it's usually to push the leverage up because you're overpaying for the property, so you can't get the debt service isn't high enough. And so you can only leverage to like 60, 65, 70%. But if the income of the property is high enough, you should be able to leverage up to 80% is usually debt cover constrained. So that's, one reason. And then the other reason is they don't have the resume or the experience or track record to be able to qualify for the lending. So like last year alone, I borrowed, I think it was like around on $100 million worth of assets. So it must have been around 60 to 70 million just from Freddie Mac alone. So when they already know us as a sponsor team, and Ellie, I always joke like we're kind of rivals because Ellie has her Fannie Mae debt that she loves, and we've always done Freddie Mac because our terms are better on Freddie Mac, hers were better on Fannie Mae, and both of the lenders were actually looking at this deal and have been kind of like fighting over it because it's such a great asset they want to be lending on. It's low risk in their opinion.
Okay. Thank you for all of the information. So yeah, when I'm looking at deals as an investor, the things that I look for in terms of the financing are, I want to make sure that we have at least 7 years on a term before any sort of balloon payment, because 7 years should ride out any market cycle, at least in real estate. And ideally 10 is super conservative in terms of having the debt service coverage ratio handle that principal and interest for 10 years or just the last 6 years of it. And when you get 4 years into the deal or 5 years when the interest only has been completed, then the cash flow from the asset should be even stronger. But the principal and interest payments could potentially even be covered much earlier, right?
Mm-hmm.
So
we underwrote it with 4 years of interest only. And so year 5, our P&I kicks in and we can cover the payment in year 5 alone. And actually, when Ellie and I first were looking at this deal, we looked at it as a 3-year IO period. So, we can withstand a lot of downturns. And I think that's a question that investors have been asking me a lot. And I don't know if you guys have been getting the same question, but what happens if in 5 years we have to sell at a loss? And I just don't really see us, number one, being in that position. But number two, I don't see us taking that option unless there's something we can't see, which, I always laugh right now because 2 years ago, we didn't know about COVID being a thing. So, it's always possible, but I just don't see us making an exit prematurely just because 5 years is up. Like if we had to, we continue holding and reevaluating every quarter the way we normally would.
Excellent. All right. So, in terms of the asset, who would like to kind of discuss the different trims, finish outs, and how we're going to add value, increase rent, and help get people a nice kicker when we sell this asset?
I could take it or you could take it. You want me to take it?
Yeah.
Okay. All right. So I did just do the interior due diligence. So I was just out on the property a couple of weeks ago.
And how many units?
We saw all but 99. We're walking the remaining. We are walking like 81 of them this coming week. And then we would have walked all but 17 units.
Wow.
So we couldn't get into the 99 while we were out there. We either they had COVID, or there was no key, or they didn't put a pet away or something. So now we're getting all of that addressed. And I think on Tuesday or Wednesday this week we'll be walking all of those units with the exception of 17 because those are COVID units.
Okay. Sounds like a long day. All
yes,
right.
Yes, very long day. So we have 4 different floor plans here. Not floor plans. There are 1, 2, and 3 bedrooms, but we have 4 different trim levels, I'll say. And you can see here, there's pictures here that kind of show you the difference between each trim level. But essentially, what we're taking is we're taking 100% of the units all the way up to the gold level. Current seller is selling it to us with 101 units already at the gold level. So the remaining 393 are going to be brought up over years 2 and 3. So month 13 to 36, we've underwritten for renovations. Another important point that we didn't hit on during the finance discussion, we typically, in both Ellie and my model, we would usually go in and start renovating day one. As soon as the leases start turning over, we're renovating, and that's how we're actually pushing those rents. In this model, for the first year, we underwrote for 0 rent premium. So that also means we're underwriting for 0 renovation as well. So we will renovate, but we're going to shift to what's called a renovation on demand model. So what we're doing is we're conserving cash until we're in a position where we know for a fact someone is renting this unit for $150 premium because they've signed the lease. Then we go in and we actually make that renovation on demand. It allows us to conserve cash, and it doesn't afford us to like have to miss any opportunity that we could be taking advantage of just because we underwrote it conservatively. So it's kind of a nice little pivot into a new model that hasn't really been done regularly because there hasn't been a need until now. And the reason we're renovating all 100% of the units, so the remaining 393 units, is because this deal is projected to exit above $100 million. The buyer pool at that level, this is one of the things we actually really love about the asset. The buyer pool at that level gets much wider and much bigger because that's now going to most likely an institutional buyer, like a REIT, trust account, or a life insurance company, a hedge fund, a family office. Those are all very, very likely exits for who would be the buyer at the exit. Now, all of those players, they don't want to go in and spend like $2,500 to $5,000 per unit going in and renovating one by one. They want a turnkey property. Their investment criteria and their investment goals are completely different than ours. Their return projections or their return targets are typically lower than what we have for our investors in our own capital. So they can afford to pay a little bit of a higher premium on the asset as well. And that doesn't mean we wouldn't sell to another syndicator if they came along and were willing to pay the right price. And we would exit the asset earlier if there was a great opportunity. We would definitely not turn it away just because of the timeline. But more likely than not, this is going to an institutional buyer. There's very few syndicators who can actually take down an asset of this size. And well, Ellie and I are two of them. So
yeah, and I think someone asking how fast you can turn over a unit. It could be 7 to 10 days. Conservative, I would say probably 2 weeks. So with renovation on demand, we're going to wait until someone is willing to pay for the renovated unit after we show them the classic unit and a renovated unit. And then once they say, yes, I'm willing to pay $150, $170 on the renovated unit, they're signed on the lease, then we know we can go out, spend the capital expenditure, bring the team to renovate. It takes about 7 to 14 days, depending on how much work is needed to be done. And then we just, most tenants don't want to sign and then move the next day. They have their own leases. It's sometimes 30 or 45 days in, which is enough time for us to renovate.
Okay, and so how much do you plan to put in for the most from the classic to the gold? Like how much do we underwrite for those renovations?
So in terms of the
5,500,
around 5,500, yeah, and it could be a little bit lower than that because sometimes you don't have to do that much, work. But I think at most is $5,500.
Okay. All right, and then what kind of premium are we looking at then, going from classic all the way up to the top?
So with the classic, from classic to gold, we're estimating about $140 to $160. And from the partial, there are partly renovated units all the way to gold, can be anywhere between $50 and $70. So as you can see, it's not a lot of money, and we're going to try and push it, as much as we can, of course. But these are the numbers that we used in the underwriting.
Yeah. But that's not bad. If we're talking about $150 a month times 12 months, you're bringing up the rent $1,800 on that, and you're breaking even in just 3 years, just from a cash flow perspective. Mm-hmm. But that's not even getting into the value add to the asset, because $1,800 increase per year. And let's just say we're at a 5% cap rate. Just for make it simple, 1,800 divided by 5% is the same thing as 1,800 times 20, and that adds $36,000. So that comes back very, very, very quickly in just 3 years, but also adds a lot of value. So that's a very easy no-brainer when it comes to that valuation, that value of doing that renovation, especially since you're not throwing the capital out all in advance as a speculation. You're only doing it once you have that lease signed for 12 months or however long it is. Mm-hmm. So That's excellent. So just to answer a question from before, so you will be investing as a limited partner into the syndication, using the fund that I bring you access to. The fund is not a fund of like 10 assets. It's just for this. And this is for SEC regulations, just to make sure that everything is very clear. You are still a limited partner in the syndication, but I am bringing a chunk of multiple millions of dollars to buy a chunk of this asset. And it holds the same position as you would in a smaller deal that might have just been like a $2 million deal and you put $50,000. It's the same thing. But in an asset this size, for SEC rules, it's a lot simpler and cleaner just to break it down into a few pieces. So I'm just doing one big check, and on your end, it'll operate the same way. Okay. All right, my PowerPoint just kind of disappeared to my other screen. So it's stuck for the moment.
All sorts of technical difficulties.
All right. So, okay, there we go on my Mac. Okay, I'm trying to swipe screens. Okay, so on this slide, we go through some of those renovations. And when we look at the total amount of capital that's being brought into this, we're looking at a total of about $3 million for CapEx. So that's capital expenditures in the total project. And we haven't really gotten into the price of this deal, but we're looking at about an $80 million asset, right? So when we're talking about a $3 million CapEx, that's only not even 4%. Okay, but the value that it provides is substantial, as we just went over with just one upgrade. All right. Okay. Now, this is something that a lot of people have been asking questions on. So we're going to kind of walk through this one just a little bit more slowly. Who wants to kind of go over the capital stack?
I'm happy to address the capital stack because I've been getting a lot of questions on this too. So the first part of any capital stack on a syndicated deal that you're looking at is typically going to be whoever your lender is. So, and I can't see the slides because they're so teeny tiny on my screen. So the first 62 million-ish are the lender dollars. And is that...
Yeah.
Okay. You'll just have to tell me what it says on there and I'll explain it further. So the first part of the capital stack is going to be your lender dollars. The second part Victor left my screen. I don't know where he went. Okay. The second part of the capital stack is actually going to be, we've allocated for what's called preferred equity. So what that is that's like these large institutional funds, these hedge funds, who have institutional dollars that they need to place and they need to return. So oftentimes they'll come in as just kind of a smaller player and they sit subordinate to whoever the senior lender is. And then after that, we have the equity stack, which is what we all collectively are investing into. So in this situation, we actually have two preferred methods to invest into the equity stack. It's either going to be the Class A or Class B shares. Your Class A shares are going to be a 9% preferred return, meaning that you get a 9% upside in cash flow throughout the life of the deal. And that's all you get, though. You don't share in any upside risk, upside and any downside risk at the end of the deal. The Class B shares are going to be so that you can invest, let's say you invest $100,000 and you're going to get around a 7%-ish. You get a 7% pref, and then throughout the life of the deal, you're going to get a little bit more than 7% based on our pro formas. And what that means is there's a 70-30 split after you hit that 7% annualized return. So 70% of any return dollars after that goes to you as the investor. 30% comes to Ellie and I as sponsors. Now I'm just all by myself on this slide. I don't even know if Victor and Ellie are here anymore. Oh, I think something's happening.
You can divide your investment and put some in Class A. Correct. And some in Class B. So we have a lot of investors that actually invested in a combination, and they put 25%. Let's say they wanted to invest 100K, so 25K in Class A, 75K in Class B, and that way they, the lion's share of the investment is still getting a piece of the equity, but the overall cash on cash increases a bit because 25% of it is in Class A, which are projected to receive 9%. So I know it's a little bit more complicated. It's kind of maybe a new structure, but this is it's an $80 million deal. It's a pretty large deal, and I think it's very similar to probably what other institutional syndicators are doing as well. So if you have any more questions about exactly how it works, which one you should choose based on whether you are more of a cash flow investor or an appreciation investor, maybe both, Victor is your guy, and you should definitely reach out to him and ask him about that.
Yeah. So the way I look at it, I mean, people who are retirees, for example, 9% cash flow is incredible, right? So if you're a retiree and you don't have much tax liability because you don't have active high earned income, then Class A is a fantastic place to sit. You do have to be cognizant of the tax liability that will be due down the road. Even though you get a negative K1, at the end of the deal, there will be depreciation recapture. And that depreciation recapture is a taxable event after the sale. So you can have other losses potentially to help you out, but that 9% is a pre-tax number, and there is tax liability based on your K1 because you would still get a K1 distribution. Is that correct? They will get K1s?
Yes.
Right. Okay.
Yeah, they will get K1s. And I went back to the CPA to find out because Ellie and I had the same question about how is that 9% going to be treated, or will it be able to utilize the negative K1 that we typically see on our assets. Thank you, cost segregation. And so the CPA confirmed that because it is a pro forma return and not a debt, it's an equity investment, not a debt investment. So they should be able to realize the benefits of that negative K1 during the hold period. And like you said, there's always the depreciation recapture, but this is also like way out of my pay grade. I know enough to be like very lethal. And so I always direct investors back to their CPAs to ask these specific questions as it relates to their tax situation, because your tax situation is going to be different than mine and different than Ellie's. So you want to make sure that you're talking to someone who actually knows your portfolio and has a license to give you this advice as well.
Right. And so that is something to be very aware of, and that there isn't like a bonus at the end on the cash flow in terms of the capital gains on the sale. There is no upside on the Class A.
Correct.
So for myself, I would invest mostly in Class B, if not all in Class B. It depends on how much money I'm allowed to squeeze into this, because I would like to put more than I think I'm allowed to, just because we have so many investors. But if I could put more in, I'd probably put in a little bit more Class A. But the 70-30 split after a 7% pref is a good position to be in for the long road. Now, in terms of the layers and that pref position, so the Class A is still preferred over the Class B. That's correct?
Mm-hmm. Correct.
They're not sitting alongside each other. That A has to get paid out. So even if there are, let's say, bonus distributions distributed in year 2, year 3, and then let's say something goes bad in year 4, and distributions are paused for a while, Class A would have to get all caught up before Class B would be able to be caught up, right?
Correct. But everybody, all the passive investors get caught up before we get caught up.
Yeah.
So just to be very clear, when we pause distributions,
pref and a pref.
Correct.
Yes.
Right.
Okay.
All pref, but we are absolutely the bottom of that totem pole.
Right. Yes. And that's like 7% is the minimum pref on that entire stack of preferred equity. So the sponsors are not getting any extra distributions of capital unless 7% has gone to all of the equity above them beforehand. Now, because the general partners, including yourselves, are investing 7 figures of capital here, where does that capital sit? Does that capital go in as a separate layer? Does it go in as a GP layer, or does it go in as a separate investment on the limited partner side?
So this is just like any other investor. We're getting, the same terms that we're offering investors, and this is something that I do on all of my deals, and I'm sure Veena does the same. Let's say we offer class ABC, and investors can choose. Then, as a sponsor, I choose, maybe I'll take $500,000, maybe 200K, maybe $1 million, whatever it is. And I choose one of the investment, the share classes that I offer my passive investors, and I invest passively. So when I invest, the day that everyone else in that share class, everyone else is getting their money, I'm getting my money too.
Yeah.
So it's the same. It's basically the same distribution schedule as other investors. And then when it comes to my compensation as a GP, after everyone was paid, then we're paying ourselves.
And I think it's important to just so investors know why we structure it this way. It's because we want to align our incentives with your incentives. So when we run completely parallel to you within your share class, that's how you know that we are just as invested into the deal in terms of the actual asset class versus being in a completely separate bucket where now we have the ability to take our money out first, or to prioritize our funds, or to make decisions based on how our funds are treated. Now we're all being treated the same. So Victor's funds, Ellie's funds, my funds, other fund managers' funds, passive investor funds, everybody sits in that same share class, and all of our incentives are aligned, and we are treated the exact same.
Okay, so for clarification, and this is covered on the next slide. So for Class A, so first of all, the minimum investment is $50,000 for people if you're only investing in Class B. Okay, if you have any portion that is Class A, then you need to have it in total investment of at least $100,000. Okay, so if you're putting $100,000 in Class A shares, you'd put $100,000 in, and you would be expected to receive 9%, so $9,000 every year for each year until it sells. Okay, so if it sells after the 5th year, you would have received 9,000, 9,000, 9,000, 9,000, 9,000, and then you would get your principal back, the 100,000. Whereas if you invest in Class B, and again, you can do this with just 50,000. Or if you wanted to put in 50,000 in Class B, 50,000 in Class A, you can do that because it adds up to 100. But if you just put 50,000 in Class B, and if you're a new investor, first-time investor, this is a great position to be in because it's not as much capital. You would get you'd have a preferred rate of return of 7%. So that would be $3,500 per year in year 1, year 2, year 3, year 4, year 5, or until whenever it sells. When it sells, the extra money that is left behind, 70% of that will go to Class B investors, and 30% of that will go to the general partners. That's above all of the other pref payments that have to get paid out. So if the preferred equity has a portion there, they have to receive. That has to go first, the top layer. But yes, that would be 70-30. Now, there is also possibility that there's excess cash available at other times. So maybe not the first 1 or 2 months, but maybe at the end of year 1, that there's a lot of extra capital, or maybe let's say at the end of year 2, once there's a lot of extra capital, but we're also a lot more comfortable of what's going on with COVID and otherwise, and that extra capital can get distributed at any time based on keeping the balance sheet in a safe, prudent position. That extra capital follows that 70-30 split as long as the prefs have all been met. Is that correct?
Yep, that's exactly right.
All right. So ideally, the property will appreciate, and that at the end you will get a nice bonus above and beyond your 7%. But you are taking some risk that you will get that, which is why you're at a lower level and you're only getting that 7%. So 9% is definitely a safer position on a cash flow perspective, but 7% with 70/30 has a lot more potential upside. Right. So with a conservative pro forma, the IRR, which is mentioned on the next slide, we're looking at around 14 to 15%.
Mm-hmm.
And we covered IRR back on episode number 45. So you can go, and actually I have a calculator on my Facebook group. So if you guys want to download that, and you can punch in numbers to get an idea of what that type of IRR feels like and what things might be higher or lower. You can crunch all of that. Okay. Now, we have a question about the property management. So I think we've covered the investment portion. The equity multiple, which we also mentioned in that same Facebook episode number 45, is 1.45 for the Class A, which is very simple. It's just 0.09 per year times 5 years, so 1.45. And then the equity multiple on the Class B is projected at 1.77. So you get 77% more than your original capital. Okay, and you get a good amount of that at the end. So go ahead.
And that'll change, it'll shift as you move shares between your Class A and Class B investments.
Yeah, so depending on how much of a pile of Class A we have, because Class A is taking a higher cash-on-cash return, that can deplete the cash a little bit more, but there would be less Class B shareholders, so that 70/30 split changes. So there's going to be some flex based on the proportion of investors in each layer. Okay, and we're limiting the amount that we're not going to have like 80% of people in Class A and completing all the cash out.
But I will say, Ellie and I underwrote this like 75 different scenarios with, okay, what happens if we have 0% Class A? Okay, what happens if we have 50%? What about 32%? So we have underwritten this to death, and we have like a very good idea of where we end up. Typically, the numbers that we project to anyone that's, our funds coming in or any of our LP investors are going to be kind of what we think is maybe more of a worst case realistic scenario versus a best case scenario.
What's interesting is yesterday, so Kate and I did our first like Saturday night date night in a while, because we just got a new nanny. And anyway, we had someone cover Saturday night, and we went to a drive-in. Okay, so these are our date nights now. And so we made it there like just in time, but we hadn't decided what movie we were going to watch. And we decided that we were going to see Bill and Ted Face the Music.
Oh,
I think it was called. This is like
the 90s.
No, this is a new Bill and Ted movie.
Oh.
It's 2020.
Okay.
I haven't heard about this.
Okay.
But Ellie, have you heard of Bill and Ted's Excellent Adventure? You didn't grow up in this.
No.
This is like such an American movie. Like there's like
Super good.
this is like not a quality like.
You did not miss anything.
But it was like in 1989 or something, I think is when it came out. And I think they had two. They had Bill and Ted's Excellent Adventure, and then maybe I think there's a second one. And they're like these rock star guys, or not really rock stars. There's these two guys who think they're rock stars. And they had like a sequel, and they're like 25 years older. It's Keanu Reeves. Okay.
Oh.
It was actually the same original people. And the only reason I bring this up is because you said you ran all these different scenarios. In Bill and Ted's, like they travel through time in a telephone booth, and they had to like keep going back, and they're like, there's infinitely many possibilities of the future, and you can go back, and there's always infinitely many possibilities of the future from any point in time. So when you're doing underwriting, it's kind of a very recursive thing. And there's a lot of different possibilities. But the movie was actually, we enjoyed it. I mean, for like a fun date night at a drive-in. It was fun. Actually, there was Grease on the screen next to it though. And for a drive-in, like that was like awesome. I've seen like Grease a bajillion times, but we were able to see Grease. Like I could like sing the songs, watching the dances on the way. While we were watching the other movie.
It was a 2-for-1.
Yes. All right. I didn't tell them that we watched the other movie. Okay. Can't do that in a regular theater. That's one of the bonuses of going to a drive-in. Okay. So that's our break there. Let's see. I think we covered all of the important things. We talked about the location, talked about the sponsors, talked about the debt, talked about how to invest, the capital stack. And then the last we have here is property management. Okay, so where does the property management come? Meaning, is it vertical integration or a different management company that manages the property? So I'm going to let the secret out here. I have my own management company, and I'm charging mega fees. And really, I'm just doing this to get like a gigantic contract. I wish I had like some institutional grade property management company. So how are we going to do it on this asset?
So we're working with a great company that we're already working on our other Atlanta assets, and they are also responsible for our success in managing those assets. And they're called First Communities. You can look them up. Very, very strong, very, very well-known company. The lender knows the company, and they've managed, I think, 30 or 40,000 units across the U.S. Their headquarters is in Atlanta. So they know the market inside out. They have a very, very strong and solid operations there. And that's what we're going to do. I mean, if, they were great with our other assets in Atlanta. We have been overperforming. There's no reason to not partner with them, because we're hiring them, we're paying them a fee, but there's no reason not to bring them on board and let them manage this property. I also saw another question, by the way, if Veena and I work together. Yes, that would be deal number 4 for us. So we've worked together on 3 other deals. Mm-hmm. And we work well together, we operate well, and we perform well. So that's for that question. I thought it was an important question. I just see it kind of on the screen.
Thank you. Yes, that's very important. We were going to address. So what other, have any of those come around, or what's the current status of those other deals that you're working together on?
So we haven't exited any of them. They're a little bit too new. The oldest one being about 2 years now, Ellie? I think so. Our Dallas property is about 2 years old now. And so we haven't come full cycle on them. But I will say that the synergy that we have with how we underwrite deals, and Victor's actually a partner on some of those as well. So just the synergy, I think, between all of the team is very strong. And I want to actually circle back to the property management thing and add one more kind of piece of information, because I know probably some of Victor's investors are wondering, they know we have a full vertical on the Enzo side. And so they might be wondering why we are not bringing them into property management that manage this asset. And it's very specifically because it's not a market that we are currently dedicated in. And it truly would not be in the best interest of the asset. It would be in the best interest of fees for us, but it would definitely not be in the best interest of this asset. And, and I say that because I want to reinforce the point that Ellie and I are both very, very much investor driven. We're very much return driven. We are not fee driven. We're not looking at, how this benefits us. We want to know how it benefits everybody, because when you guys benefit, we benefit.
Yeah. So at an $80 million asset, there's a lot of benefit that could come through the pipeline for everybody. And making money on the property management is that's probably small potatoes.
Yeah. I hate property management, to be honest. So we both come from property management backgrounds.
Managed property, right?
Yes.
I can tell people you don't invest in real estate, so you don't become a doctor so you can do dictations, right?
Yeah.
Starting. Like you do to take care of people. You don't invest in real estate so you can manage the asset. You invest in real estate because of the investment quality. Nobody says, I want to grow up and I want to just do all this work, right?
Yes.
There's not really much glory in property management.
No.
The money comes on the other side. So you had also asked if I can share the slide deck. Yes, this can be in my Facebook page. I will share it there. For those who haven't gotten it, you should be able to download it from the email that I've already sent out. And if you're not on the email list, then you need to sign up on the syndication list. That way you're kept abreast of everything going on otherwise.
So
Okay.
Victor, if I can just add one more sentence about the property management company. We are still involved in the operations. We're managing the asset, and for the investors that don't, fully understand the difference, the property management is basically the company that hires people to sit there in the leasing office, collect rent, answer questions, fix, when the stove is broken. Exactly. We are not doing this. We are basically managing them. So we're reviewing with them on a weekly basis the reports, the metrics, how the property is operating, making decisions on, increasing rents, renovating units, all of that. And they are the boots on the ground that are actually operating the property. So it's not like we're purchasing a property and we're
running away from
the property management. Just manage it. It's nothing like that. We're very, very, very hands-on operators. But we like to work with the best. We don't try and do everything. We know where we're strong and where we need, to bring someone else we just like to work with the best, professionals in every field. So that's kind of how it works, between asset management, which is managing the property management, and the property management itself. So just wanted to make sure that is that investors understand that.
Yeah, so that's a very good point. That's what one of the biggest advantages of buying at this scale is, right? Because when you're bringing this scale, you really can prioritize people doing only what they're best at. That's what we medicine say, operating at the top of your license. And so when you have that many units, at the end of the day, you can actually get better service, right? And you can get cheaper, better, and it's better for everybody, right? Like when I outsource things at my house, you have to let go of some things. But then when the first time we hired a housekeeper, I realized she does way better job than I would have ever done.
Yes.
Right. Right. So that's like doing this for a property of 500 doors, right? You're not going to want to go there and clean the place yourself. That's not feasible. And at this scale, this is a big property. So when you're working with other contractors at this scale, you can get very good service, and the rates you pay are a lot cheaper than if we were doing this in the single family space, right? Oh, yeah. So on a percentage of gross receipts, what is the usual property management amount on assets like this?
3%.
3%. So if any of you guys are doing single family properties and you're going to try to get someone to do property management for 3%, not going to happen.
Very hard.
And you're not going to have property management that sits there on site, answers every phone call, takes care of things with people there. I have somebody who manages one of my single families, and it's pretty cheap, but I still have to answer all these questions all the time. It's just an intermediary. This is everything's taken care of, and you're just managing the business, right? Not necessarily managing the property per se.
Exactly.
All right.
We're not taking the 2 a.m. my toilet is leaking calls. We're taking the calls the following day or that week, whenever that call happens to be, saying, why is the toilet leaking? Do we have something major we have to address, or is it just a one-off?
And whenever I hear that question about the 2 a.m. toilet, it makes me wonder, what are you doing at 2 o'clock in the morning?
Your toilet's leaking.
And then that brings it up, and then you decide to call at that time.
Oh gosh.
Really? Yeah. Let's think about this. Put this all into perspective. Okay. So what other questions do we have? And please put your questions on here, because when you run out of questions, we're going to have to call it. When do you plan to close on the property? Well, the pro forma is for 5 years, right? Yeah. As we mentioned, we have interest only for 4 to 5 years. So we can comfortably hold on to the asset for that period of time. But the mortgage is a 10-year term at the moment is the window. So it could be longer, could be shorter. Let's pretend, Ellie, in 3 years you meet your pro forma goals. Would you consider selling it at that point?
So we'll have to run the numbers and see if we can sell now, if we think that the market is strong enough that we maybe can exit at 16% IRR or at least 15% IRR and basically hit our pro forma numbers. My inclination would be, if I can do it now, why wait for 2 more years and risk it? Maybe we won't be able to do it. As a sponsor, I'm going to get, my income is going to be shortened because there are 2 more years that I'm not making, any fees. But that's fine, because it's when my investors are happy, they're coming back. And that's what I care about. Happy investors, and not so much about, whatever 6 figures that I'm, losing over 2 years. If it makes sense, we'll do it. If it doesn't make sense and, we can exit and make 13 or 12.5% IR, then my inclination would be, let's keep it and wait, and maybe look at it 6 months from now. Not necessarily wait 5 years. Let's evaluate it like, Veena mentioned, every quarter. Let's look at what the market is doing, and this is whole operations of bringing the broker to give us BOV, but basically, give us some range of what he thinks the property can sell for, getting the property ready for a sale. And also because our buyer is going to be institutional buyer, we would want at least to hold it for 3 years so we can finish all the renovations, because they don't want to do the work. They're not, scrappy and hungry. They want turnkey property. So, but I think the question was when
we're to close on it. Sorry, when are we going to buy?
Yes. End of October. But the fund, everyone is wiring, the funds way before that, because we can't wait for the last minute.
People are like, well, when are you closing? And then I ask, often when people ask me a question, it's like, now that I've been married, I understand.
What does that mean?
It took me a long time to realize people ask questions, but that's not the questions they're asking.
Oh, stop. Kate never is misleading in her questions. I know she's not.
So, when are we closing? When we're closing is irrelevant as to when your money needs to be coming, because we're raising 8 figures of money. You can't wire that money in 2 days before closing.
No.
That money needs to be in the bank account.
So the way that we typically treat our wires, because we get so overfunded, and I think I shared on the last podcast that we did, I have investors who wire funds before they have signed documents, which you should not do ever, period. Always wait for signed documents. That is your signal that you are invested into the deal. Then you can wire your funds. But the reason I say that is because I always end up actually not just soft committed overfunded, but also wired overfunded. And I have to wire back funds to people. So I kick mine out in the reverse order they come in. So I use the timestamp of when you send me a confirmation of wire as being funded into the deal. Because if I have 2 come in and one comes in at 8 p.m. on Sunday night and the other one comes in at 8 a.m. Monday morning, one might hit depending on how it goes through the clearinghouse or which bank it went through. But the one that came in or that was time stamped for 8 p.m. Sunday night is going to get preference over the one that came in at 8 a.m. if I'm completely funded. So we give you 3 days from the time that you, and Victor, this would actually apply to you as our fund manager. When I send you the documents, you'll have 3 days to sign and wire to me. And I assume you follow or you have some kind of timeline for your investors at your fund. I don't know what that is, but maybe
that will be determined once we have the final papers from our attorney.
Okay.
Yes. Ideally 3 business days.
Yeah.
That way you have the documents. You can review everything before. There's nothing you're not going to have to sign everything and wire money all the same day. This is not that kind of a situation.
Yeah.
But we would like to have all the money ideally by the end of September. Documents signed and money transferred to our fund and directly over to you. So that is off of my books, because I don't want to have
It's first come, first serve for us.
Possible.
Yeah.
All right. So who wants to cover the fees?
I'm happy I'm happy to cover those. So that's a good question. I think everyone should be looking at that whenever you're investing into any deal. I think the most important thing to remember as we talk about these is all of the projections that we put into your pro forma is net of fees, not gross of fees. So everything that we show you as a projection is once all of our fees have been accounted for and taken out. So the first fee that we typically have underwritten into our PPM and our underwriting is the acquisition fee. In general, I would say the industry standard is anywhere from 2 to 4% on that. If you have invested with Enzo before, we typically are on the higher side of that. And on this deal, because of the sheer size, we're actually only taking 2% on it. What that acquisition fee is for is not just the amount of work that goes into acquiring this project, but I always like to say that acquisition fee is for in this case, like 399 other deals that you haven't even seen because I already said no to them for you. So that's the acquisition fee. Then we have a financing fee. So in order to get a loan, especially a loan of this size, we need to meet certain net worth requirements, certain liquidity requirements, certain experience requirements, certain track record requirements. And without doing that, Fannie and Freddie will not loan to us. So all of the work that goes into it, the risk that goes into taking that onto our balance sheet, all of that is accounted for in a financing fee of, in this case, we disclose up to 1%. Then you have an asset management fee. So that's for the ongoing management of the assets. So when Ellie was saying, look, we're going to meet with property management on a weekly basis, we determine whether it's a correct exit point in year 3 or every quarter or wherever that looks like. All of that is accounted for by our asset management fee. That is up to 2%. And then we have a disposition fee. And in this case, the very large scale disposition. So we're looking at up to 2% on that. And I say up to because Ellie and I are both very, very strict that if we don't perform, though our fees are the first fees to go and the first fees to get cut. And most specifically, I think the asset management fee would be the first one to come off of the books before any investors were seeing any kind of pause or anything like that on their investment. Oh, and the refinance fee, that's the only other one I forgot. So that's up to 1%. And that would be if we did like a refinance or a supplemental. And basically that's accounting for, again, the level of risk, the experience, the track record, et cetera, so that we can take new debt on or change the debt or pivot in the case that we need to.
All right, thank you. Okay, who does money after the sale of the asset qualify for a 1031 exchange?
Yeah, I think, Victor, this is more of a question for you because investors in your fund, I believe that if you take the fund and offer investors after the sale, hey, we're going to do another fund, then they'll be able to invest with you. But this is mainly a question for you.
Yeah, so this is a very complicated question. In an ideal world, yes. In a real world, maybe, but don't count on it. I would ideally like to promise that, but it's the issue with real estate is that it's illiquid, right? And people often want capital, even if at a certain time in their life they don't plan to want capital. 5 years is a very long time in the future. 5 years ago, think about what you were doing and think about what you might be doing 5 years from now, what city you'd be living in, what job you would have. There are a lot of unknowns. And so I don't know. The best way to make sure you can get a 1031 deal is to invest in a tiny group of people. And I'm talking like 3 people. Right, and bring a ton of capital to the deal. I mean, you do it all yourself, possibly, where you really know. But the smaller your group of people you're investing with, the more likely that is feasible. And they should be people that you have invested with before over a long period of time, and you are all on the same page. Because if you're trying to get into a 1031 exchange, you are basically business partners with that other party. And you have to make sure that it is a business marriage that will endure. Okay, because there's a lot that goes on in people's lives that other people have, no influence on. Okay, so all right, and yes, I misread that before. So when we plan to buy it, it's under contract now, and like when you buy your own house, it takes time to actually sell or buy and close out. Okay. Future iterations for fundings. When would investments be due? For this particular asset, we are raising capital one time, and that is it. That is the plan. There's always a possibility that new capital could be needed for this asset. It would be, under our assumptions, unlikely, but it is certainly not within the realm of impossible. But that is something that we are seeing in under other deals, other syndications, where cash flow is tight with rents not coming in, and sponsors looking to limited partners to bring in more capital to float the asset during these difficult times. But there are no plans for that. And we are all conservative investors with similar longer term horizon timelines, which is why I only invest with people who have this same mentality, especially when I'm bringing in six figures to the table and talking to other investors, because I want them to protect their balance sheet. Right? I don't mind getting less capital distributed to me like today if the money is coming to me like a year from now, but I don't want the business to be in trouble, because that's ultimately what matters the most long term, right? Okay, now, yes, Kate says, I just ask questions in a friendlier way than Victor is used to.
And she's right.
Yes.
Victor knows I'm always Team Kate, no matter what.
She is always Team Kate, and that's the way it should be. Otherwise, she wouldn't watch the kids for an hour and a half when I talk to Veena for a 30-minute phone call. All right. Our distributions sent out monthly, quarterly, or yearly. The current plan, once the distributions start coming, it takes a while to settle the books out, because you have to close. And if you think about the logistics of this, the first time I did, it gave me a headache, because people don't all pay rent on time, right? And if they did, you'd want to close like on the 31st of the month or the 30th or the 20th. And then that way, all the books are transferred and all the rent comes in the next day. And that's not reality, right? And this is a lot of rent coming in. So it takes a while to clear out the books, right? You got to take over the whole asset, get your own property management team in place. This takes a couple of months, like easily. But usually, and I only invest in deals that are really cash flowing on day zero, and this is one of those. So we expect to be cash flow positive immediately. And so once the books are settled, let's say approximately the end of the third month or so after closing, like a third full month, then hopefully then the distributions will start coming monthly from the asset and then distributed out to all of the investors on a regular basis. And so if you're a Class A investor and you put in $100,000, and that 9%, that's $9,000. And so divided by 12 months, that's $750 per month. Okay, now your first distribution, so you start accruing on day zero. And if we close on the last day of October, and then 3 months accrues, and then you get paid the following month, you'll get paid in arrears. But if there's a whole 3 months there, then you get paid $750 times 3 months. That'll be $2,250. Then subsequent months will be $750 per month ongoing until it sells. Okay, there's always a possibility that they could be paused, but they will still have to be made up. If you're investing $50,000 as Class B, then you're looking at $3,500 per year, okay, which is almost $10 a day, but not exactly. $3,500 is like almost $300 a month. But so after the first 3 months, you're looking at like $900, and then like $300 almost per month. Okay, and we
imagine if people looked at rent on a daily basis like that. Who calculates it like
I
that?
round numbers. I was like, I can't divide 7,500.
3,600 a year is like $300 a month.
Like approximately. I was trying to do the exact math. Right? So I was like, do the exact math. So it's just under $300 a month. Mm-hmm. So then you would get that ongoing, and then periodically, like after 1 year or 2 years, when there's extra capital, you would get a bonus out distribution. That would be split up 70% to the Class B limited partners and 30% to the general partners. And those would come out on a periodic basis based on how much capital it is. It is a little bit of bookkeeping effort. I would not anticipate getting those every month, but depending how cash is, maybe every quarter or so, depending on where we are in the future. Now, and this is an exception, by the way, most syndication groups that I've invested with outside of working with Veena are quarterly, and some of them are even 6 months if it's like a HUD loan, depending on, they have really weird terms. But monthly is very nice, so it can fit into your monthly cash flow very nicely. Anonymous. So we want to invest $50K, but I am not a certified investor. What all do I need? So you need to be an accredited investor. So let's pretend you meet the qualifications for being an accredited investor. $200,000 of income in 2019 and 18, and expecting 200,000 this year, or 300,000 across you and a spouse. If you meet accredited investor status, Veena, can you touch on how they can prove that they are an accredited investor? Because we need to have every single investor accredited. Otherwise, SEC.
Yes, they do not like that, and neither do we. So if you meet the requirements, but you don't have the actual certification documents, your fund manager, so Victor, will send you a form to get completed by either a licensed CPA, attorney, broker-dealer, Finra registered financial advisor. Is there one more, Ellie? I think those are the 4 people.
Yeah, we pretty much covered it. I think even an attorney can sign that document, or they can go through. Well, I don't have a license anymore. I'm focused. My focus is
not your attorney.
I'm just kidding. No, I always want to use people outside of the investment.
Yeah. Yes. Or you can go to a third-party company like Verify Investor.
VerifyInvestor.com. They will do it. I think you fill out their form. You upload your proof of either income or your net worth. And then they will actually write you a letter, and it'll say, this person is an accredited investor. I'm licensed under whatever license to give you this certification. And then you just send that on to your fund manager.
Yeah. And if you have something already, if you already have an accreditation form, we ask that it would be, valid or issued in the past 90 days, because we want to make sure that it's recent and nothing has changed.
Okay, SEPC, is that what you said? I think SEC, so the Securities Exchange Commission, is like the governing body that oversees securities. So something like this, or publicly traded securities, stocks, bonds. Finra is, I don't know.
I don't actually know what it stands for. It's just like the Financial Advisors Board.
If you have a financial advisor,
I don't know.
Financial advisor,
maybe national something registered advisor,
to document that you are an accredited investor, and we do need that for everybody.
Yes.
Okay, last call.
Okay, I'm going to tell you what FINRA stands for. Financial Industry Regulation Authority.
Sounds official.
I guess the IN is for industry. There's no standalone N.
Okay, when you upload your W-2, black out your social security and maybe address before giving it to a third party for accredited letter from a broker dealer or verifiedinvestor.com. No need to give your third party accredited investor certification. If they have your income.
Hey, as long as they sign that letter and they tell us that you're verified, that's between you and whoever you're getting verified from.
I have a bunch of people come to me and show me their W-2s, and I have all their contact information. You make $1 million a year? Okay, great to know.
I think you probably are accredited, but we cannot verify that. So go to somebody who has the ability to. And I'm getting the question often because we have a lot of attorneys and CPAs and financial advisors that do invest into our deals. No, you cannot self-certify because typically your E&O will not cover you in self-certification, but also our attorney has said that it's just not, we need to meet the bar of reasonably trying to verify our investors, and it doesn't meet that bar. So, you can get your buddy to do it if they are comfortable and you can prove to them that you are an accredited investor. But it does go under their license and it does go under their insurance. So,
yeah. So, be careful. Make sure you follow all the rules. It doesn't cost much to get it done. And once you have it done, then you have it done. And, if you have other opportunities before the end of the year, it probably will hold up. So,
for 90 days from when you get it done. So if you get it done September 1st, you can use it almost through the end of the year, most likely. I mean, and some sponsors are willing to, accept a 6-month-old letter. It just kind of depends on how their attorney views it. Because there's no clear guideline from the SEC. But typically, I think 90 days is pretty standard in general.
All right. I think we've exhausted all of the questions. Let's hear it for Veena and Ellie. Thank you for your time.
Thank you, Victor.
Thank you, Victor.
You're welcome. Again, Ellie, where do we find you? What's your podcast again? Everybody should subscribe.
My podcast is called Ready to Scale, and you can find information about me, my company, my podcast. If you go to ellieperlman.com, you can just Google Ellie Perlman and you'll see my website there.
Fantastic. And Veena?
You can find me at vivefunds.com, VIVEFUNDS.com, or I'm always putting my 2 cents into your group. So you'll find me on Victor's group plenty. And if you guys think of any other questions that we didn't get a chance to answer, or if you are watching the replay on this, post here, Ellie or Victor or myself will be available. And Victor will be your main point of contact for this deal because he is going to be your fund manager.
Veena, if we had our own fund, Vive would be a good name for our fund too.
Oh, wait, why?
Oh, wow.
Oh, you and me, VI and VE. Oh, it's so true.
It is true. All right, everybody. Okay. And that's it for today. That was a marathon for episode number 56. Thank you very much. Everybody, have a good day until tomorrow for episode 57. And yes, this will be saved. I'll post the PowerPoint up in the Facebook group, and you can see the replay over there anytime.